The silver market has been shaped less by headlines and more by quiet assumptions made inside large institutions. And that's where today's story really begins, because when a bank like JPMorgan adjusts its internal tone, it rarely does so casually. And the timing of this latest shift raises questions the market hasn't fully priced in yet. At first glance, the recent commentary coming out of JPMorgan reads measured, even conservative. But the language choices matter, because when analysts start emphasizing balance rather than conviction, it often signals that something beneath the surface is no longer behaving as expected, and that's where the first layer of tension starts to form. What stands out isn't a bold forecast or a dramatic target, but the way silver is being framed relative to broader macro forces, with subtle attention paid to cross-asset behavior rather than silver in isolation, suggesting the bank may be watching correlations that are beginning to loosen. And that kind of shift rarely stays contained. There's also a noticeable restraint around supply-side commentary, not an omission, but a narrowing of focus, as if certain variables are being treated as less predictable than they were even a quarter ago. And when a major institution avoids leaning on familiar anchors, it often means those anchors are moving. Behind that restraint sits a deeper question about positioning, because JPMorgan's market view hints at caution without explicitly naming risk, and in institutional language that usually implies exposure exists somewhere that isn't being advertised, setting up a quiet imbalance that hasn't resolved itself yet. What makes this moment more complex is how this view aligns, or doesn't, with recent market behavior, where price action and flows appear slightly out of sync, implying that at least one side of the trade is operating on a different timeline, and that divergence is where pressure tends to build. And as this initial layer settles, the real issue becomes not what JPMorgan said, but what it chose not to emphasize, because in markets like silver, silence from a major player can be more revealing than any explicit call, and that silence points directly to the next fault line worth examining. The next layer emerges when you look at how JPMorgan frames silver within the broader metals complex, because the bank isn't isolating the metal the way it has in more directional periods. And that choice alone suggests uncertainty about which force will dominate next, monetary demand or industrial pull. Rather than leaning heavily on inflation narratives or safe haven dynamics, the commentary subtly balances silver between growth sensitivity and monetary hedging, and that balancing act implies internal debate, the kind that usually appears when prior models stop producing clean signals. What's notable is how this contrasts with gold, which is being discussed with more structural confidence, even as both metals are exposed to similar macro currents. And when silver starts to be treated as the variable rather than the constant, it often means volatility is being quietly anticipated. The bank's language around industrial demand feels deliberately cautious, not dismissive, but hedged, as if recent data hasn't been strong enough to ignore, yet not stable enough to trust, leaving silver suspended between competing narratives that can't coexist for long. At the same time, there's an implied sensitivity to economic momentum that wasn't as prominent in earlier outlooks, hinting that silver may be more exposed to slowing cycles than consensus assumes, and that exposure becomes problematic if markets are still positioned for resilience. This is where institutional positioning starts to matter, because when a major bank reframes risk without changing price targets, it often signals that adjustments are happening in structure rather than direction, a nuance retail observers rarely catch in real time. The result is a market that looks calm on the surface but is being internally reweighted by players who move ahead of price. And that quiet recalibration sets the stage for the next pressure point, where paper positioning and physical realities begin to interact. And once those two layers start pulling against each other, the narrative JPMorgan is shaping today may look very different in hindsight, especially if the market is forced to reconcile assumptions it's been carrying forward unquestioned. One of the more telling aspects of JPMorgan's latest view lies in how it treats positioning without directly naming it, because the absence of explicit commentary on speculative exposure often appears when internal desks are already tracking crowding risks that don't yet show up cleanly in public data. Silver has a long history of behaving well right up until positioning becomes one-sided, and the current tone suggests an awareness that participation may be leaning more heavily in one direction than price alone would imply, creating a fragility that doesn't need a catalyst to matter. Instead of warning about excess directly, the bank's language leans toward optionality, emphasizing flexibility and scenario-based outcomes, which in institutional terms usually means risk managers are no longer comfortable with linear expectations. This becomes more significant when viewed alongside recent futures behavior, where open interest has shown signs of persistence even as momentum cools, a combination that tends to precede sharper adjustments once conviction finally breaks. What's being implied is not imminent disruption, but sensitivity, a market that may react disproportionately to relatively modest shifts in data or sentiment, especially if liquidity thins at the wrong moment. JPMorgan's restraint here suggests an understanding that silver doesn't unwind gradually when pressure builds. It resets in steps, often catching both sides off guard, and that historical memory is embedded in how cautiously the outlook is being framed. There's also a subtle acknowledgement that traditional signals may lag, meaning by the time consensus recognizes the shift, positioning will already have moved, leaving little room for orderly adjustment. And that sets up a deeper issue, because when institutions begin preparing for nonlinear outcomes without signaling urgency, it often means they're watching a trigger that hasn't revealed itself yet, and that's where the next tension begins to form. Another dimension appears when you examine how JPMorgan's view interacts with currency dynamics, because silver's relationship with the dollar has grown less predictable in recent months, and the bank's commentary reflects that instability without directly addressing its cause. Rather than assuming a straightforward inverse relationship, the language suggests conditional sensitivity, implying that silver's response may depend more on the reason the dollar moves than on the move itself, a distinction that matters when macro narratives start to fracture. This becomes relevant in an environment where rate expectations are no longer moving in clean arcs, and silver finds itself responding unevenly across sessions, sometimes ignoring signals it historically would have tracked closely. JPMorgan's framing hints that internal models may be struggling to reconcile these inconsistencies, not because the inputs are wrong, but because the regime itself may be shifting, making past correlations less reliable. There's also an implied awareness that currency volatility, even without a clear trend, can drain liquidity from secondary markets like silver, amplifying reactions once a move finally commits in one direction. What's left unsaid is whether this instability is viewed as temporary noise or as a sign of deeper structural change, and that ambiguity is intentional, because committing either way would force assumptions the bank isn't ready to formalize. For market participants, this creates a quiet dilemma, because strategies built on stable relationships may underperform without obvious warning, while adaptive positioning carries its own risks in a low-conviction environment. And as these currency cross-currents continue to distort signal clarity, the question becomes how long silver can remain range-bound before one of these suppressed forces forces a resolution, pulling the market into its next phase. The fifth pressure point emerges around physical market signals, not because JPMorgan highlights them directly, but because their relative absence speaks volumes about confidence in near-term visibility. When large institutions downplay physical tightness or surplus narratives, it often reflects uncertainty in data quality rather than comfort with conditions, especially in a market like silver, where reporting lags and regional distortions are common. Recent behavior suggests that physical flows aren't cleanly reinforcing paper pricing, creating a disconnect that's difficult to model and even harder to trade around. And JPMorgan's cautious tone implies that this mismatch is being closely monitored. The bank's silence on inventory dynamics hints at variability beneath aggregate figures, where localized constraints may coexist with broader availability, producing signals that cancel each other out at the macro level. This matters because silver tends to respond abruptly when physical demand asserts itself after long periods of dormancy, and institutions that recognize this pattern rarely announce it in advance. Instead, they adjust exposure quietly, treating the physical market less as a directional driver and more as a volatility amplifier, something that doesn't lead price but can accelerate it once momentum takes hold. JPMorgan's framing suggests that this amplification risk exists but remains conditional, dependent on timing rather than inevitability, and that distinction keeps expectations anchored while contingency plans evolve. As long as physical signals remain ambiguous, the market can maintain equilibrium, but that balance is fragile, and when it breaks, it usually does so faster than participants expect, setting up the next area of stress worth examining. Part of what makes JPMorgan's latest view difficult to parse is how it treats time, because the outlook doesn't anchor itself to a clean horizon, and that omission is rarely accidental in institutional analysis. Rather than emphasizing near-term catalysts or long-term structural themes, the language hovers in an intermediate space, suggesting that the bank sees risk accumulating without a clear schedule for release. This temporal ambiguity often appears when probability distributions are widening, not because outcomes are extreme, but because the path between them has become less predictable. Silver in this context is being treated less as a trade and more as an exposure, something that can sit quietly for extended periods before responding sharply to shifts elsewhere in the system. JPMorgan's restraint around timing hints that internal scenarios may diverge significantly depending on macro sequencing, with similar inputs producing very different outcomes based solely on order and pace. That kind of sensitivity makes traditional forecasting less useful, forcing institutions to focus on resilience rather than precision, and that shift is subtly embedded in how the view is being communicated. For observers, this creates the illusion of stability because nothing appears urgent, yet beneath that calm sits a recognition that delayed reactions can be more destabilizing than immediate ones. And as time becomes a variable rather than a constant, the question shifts from what silver will do to when the market will realize its assumptions about timing no longer hold, opening the door to the next layer of risk. Another signal sits in how JPMorgan's view aligns with broader institutional behavior, because the bank rarely operates in isolation, and its language often reflects conversations happening across desks rather than a single internal conclusion. When multiple institutions begin expressing similar restraint without coordination, it usually indicates shared uncertainty rather than shared conviction, a subtle but important distinction in markets driven by expectation. Silver's current treatment fits that pattern, positioned neither as a clear hedge nor as a growth lever, but as something in between, an asset that resists easy categorization at this stage of the cycle. This ambiguity can persist longer than expected, especially when macro data sends mixed signals, but it also increases the likelihood of abrupt repricing once consensus finally tilts in one direction. JPMorgan's framing suggests awareness that peer institutions may be adjusting risk parameters quietly, reducing tolerance for drawdowns without overtly exiting positions. That kind of collective caution doesn't move markets immediately, but it changes how they react to stress, making rallies more selective and sell-offs potentially sharper. The danger for participants lies in assuming that stability equals confidence, when in reality it may reflect a pause driven by risk management rather than belief. And as this cautious equilibrium holds, the final question becomes what happens when one institution breaks formation, forcing others to respond, and that inflection point leads directly into the final phase of this analysis. The final layer comes into focus when you consider how JPMorgan's view might be interpreted rather than what it explicitly states, because in markets like silver, perception often moves faster than fundamentals. By maintaining a measured, non-committal stance, the bank effectively leaves room for multiple outcomes. But that flexibility also invites others to project their own biases onto the narrative. Some will read restraint as latent bullishness, assuming caution precedes accumulation, while others will interpret it as early warning, a signal that risk is being trimmed ahead of potential instability. This divergence in interpretation can itself become a catalyst, not through news or data, but through positioning decisions made in anticipation of what others might conclude. JPMorgan's language allows for that ambiguity, which is useful institutionally, but destabilizing for a market already sensitive to shifts in expectation. As these interpretations circulate, the gap between belief and reality can widen, creating conditions where even modest developments force rapid reassessment. Silver has historically responded to these moments with abrupt transitions rather than gradual trends, and the current environment appears increasingly vulnerable to that pattern. And as this view filters through the market, the unresolved tension isn't about direction, but about readiness. Because when clarity finally arrives, it rarely gives participants time to adjust. What JPMorgan has put forward isn't a forecast meant to guide the public, but a posture designed to preserve optionality in an environment where familiar signals no longer line up cleanly. The calm tone masks a recognition that silver is sitting at the intersection of competing forces that can't all remain dormant at the same time, and history suggests that kind of compression doesn't resolve quietly. Rather than calling for a move, the bank appears to be preparing for one, acknowledging that the next phase may be defined less by conviction and more by reaction. For those watching closely, the takeaway isn't reassurance or alarm, but awareness. Because when institutions begin managing for uncertainty rather than direction, the market is usually closer to change than it appears. And until one of these pressures asserts itself decisively, silver will likely continue to trade on borrowed time, with JPMorgan's measured stance serving less as guidance and more as a reflection of a market waiting for its next reckoning.